Trinidad and Tobago's new asset tax affect your investments? I'm Kalila from Money Media, giving you money news for the Caribbean. The Trinidad and Tobago government says come January 1, it will be implementing a 0.25% asset tax on commercial banks and insurance companies. This includes companies like Republic Bank, CIBC, NCB, First Citizens, Scotiabank, and others in the sector that are listed on the Trinidad and Tobago Stock Exchange, TTSC. According to the country's finance minister, the money will be used to help fund the 59 billion TT dollar budget for 2026. The government expects to earn about 575 million TT dollars from the asset tax, nearly a tenth of the budget. That's about 13 billion JMD or 87 million USD. An asset tax is a charge a company pays based on what it owns, not on the profit it makes. The assets can be anything: cash, loans, buildings, machines, and investments. So even if a bank makes less profit in a year, it would still pay the asset tax because the tax looks at the size of its assets. It's different from income tax, which is a tax on the amount of money earned. Trinidad's government said the tax will be applied to all commercial banks and insurance companies that operate in the Twin Island Republic, except those under the Special Economic Zones Act. The finance minister said the government needs the money to close the budget gap and keep services running. According to the budget breakdown, the government plans to spend 59 billion TTD, but is only expecting to earn about 55 billion, even with the asset tax already factored in. That still leaves them short almost $4 billion. Now, Trinidad is not the only country that has an asset tax. Jamaica has one too, but banks have been lobbying for years for its removal. They argue that it drives banking costs up and is one of the reasons they can't drop interest rates as fast as we'd like. In 2019, the Jamaican government reduced the asset tax on financial institutions and removed it completely for non-financial ones. But some people want it gone altogether. The government had planned to cut the rate in half in 2020, but didn't because of the pandemic. Back then, the financial sector agreed that there needed to be certainty in the country's revenue collection. Just that 50% cut alone would have cost the government $3 billion in revenue. So there's obviously a good argument to keep the asset tax and, in Trinidad's case, implement it because they need the money. But as the Bankers Association of Trinidad and Tobago said, the tax could hamper companies' expansion and affect financial stability. And it could also hamper these companies' profitability. So if you're invested in the banking or insurance sectors in Trinidad, expect lower returns and dividends. And that's the bottom line. Now, my Trini followers, how do you guys feel about this news? Let me know in the comments. And if you want to know what to look for when you're making your investments, go to moneymissionja.com for info on all our courses and books. The link is in my bio or in the description. Let's get this money.
Let's get this money.